I'm Robin John from Wellden Turnbull, and I'm going to talk to you about the Chancellor's 2016 Autumn Statement. Up until now, we've had an Autumn Statement and a March Budget. In future, we're going to have a major change. We're going to have an Autumn Budget and a March Statement. I don't know if we'll notice a great deal of difference, but there it is. The first thing to look at is that it's very interesting to see where the government actually gets its money from. This is an analysis of the 2015-16 tax revenues that have been raised. You see the big three: income tax, national insurance and VAT. Those of you who might be thinking when we leave the EU we'll be able to get rid of VAT, I think that's unlikely. It's a huge contributor to government revenue. It's also very interesting to see where the others come from. Fuel duty is a big one, tobacco and alcohol duties. Stamp duty land tax at £11 billion is now a major contributor to the government's coffers. A lot of people were hoping for a reduction in stamp duty land tax because it's seriously disrupted the market for higher priced houses in the southeast, but obviously the Chancellor decided that he wasn't going to do anything about that. It's also interesting to see inheritance tax. £5 billion is not a lot of money to the government in relation to the other taxes that it raises, particularly given the controversy that inheritance tax causes. Inflation has an interesting effect on the government's finances. The national debt at the moment is about £1,800 billion or thereabouts, and of course it goes up as we speak. The prediction is that inflation might hit 2%. A 2% inflation rate reduces the real value of the government's debt by £36 billion. It's interesting to compare that to the revenue the government raises from some taxes. It's almost as much as the revenue from corporation tax on its own. The Chancellor talked a lot about infrastructure, and in some ways this is quite a sound investment decision. The government's borrowing costs are generally less than 2%. If it can invest in infrastructure that will give it a greater return on this, then clearly it's an investment worth making. Some of you will be aware that local authorities seem to be buying lots of land recently, and I wonder if that's a reflection on the fact that the government's borrowing costs are effectively so low. So even a relatively modest yield means that they receive a positive rate of return. It's an interesting point that if you look at the tax gap which the government talks about, the Chancellor did say that the UK's tax gap, which is the difference between what the government thinks it should raise and what the government actually raises, is down to 6.5%, which is one of the lowest tax gaps of any country. In addition, the estimate in that tax gap is that the loss of revenue from tax avoidance schemes is something like £1 billion, which in the context of government funding is not a huge sum of money. The government proposes to introduce penalties for people who market tax schemes. It's also proposing to introduce legislation to attack the self-employed version of disguised remuneration schemes. I'm assuming that this refers to these contractor loan schemes for self-employed contractors that you see around. There's also problems in store for people who have undertaken schemes that get overturned in the courts. The Revenue's view is that if somebody has entered into a scheme which they didn't understand and which they didn't take advice on, then their argument now is that that person has been negligent and that they would be subject to a penalty of between 15 and 30% if they can argue that their negligence was merely careless. A particular point they are making is that relying on non-independent advice is not taking proper care. So if anybody entered into these schemes relying upon the advice of the people who sold them or the people who are being paid commission to persuade you to buy them, then that is not taking proper advice, and potentially you will find yourself subject to penalties. A salary sacrifice is where an employer gives his employee a menu of options. He can choose whether he wants a higher salary, a pension contribution, car, or so on, and his salary package is adjusted accordingly. In many cases, depending on the benefits that are chosen, the government gets less tax. In future, the proposal is that salary sacrifice arrangements will be taxed on the same basis as if the salary had been taken, except for specific exemptions: pension, childcare, cycle to work, and ultra-low emission cars. The intention is to raise extra revenue by taxing the sacrifices on the same basis as the salary. Of course, in practice, I can see this would only apply to a formal menu arrangement. If you work for your own company and you're both the employer and the director, then clearly you don't have to offer yourself a menu. You can agree whatever terms you like. Changes to non-domicile taxation were announced over a year ago, and the government has confirmed that it is going to go ahead with these with effect from April 2017. From that date, a person will be deemed to be domiciled in the UK for all tax purposes if he has been resident in the UK for 15 out of the last 20 years. So he will no longer be able to elect to be taxed on the remittance basis. In addition, inheritance tax will be charged on residential properties owned through offshore companies. At the moment, many non-domiciled individuals own UK residential property through non-UK companies. So the asset that they own is not UK property, it is the shares in an offshore company. So if they were to die, there is no inheritance tax. The government proposes to publish draft legislation sometime in December, so we'll have to wait and see what that says. It was previously announced that the rate would reduce to 17% by 2020. George Osborne did suggest that he would reduce it to 15%, but Philip Hammond seems to be sticking with the 17% target. In addition, the government proposes to attack interest relief for groups with more than £2 million of interest, where this will be limited to either a proportion of the UK taxable earnings or a proportion of the total group debt. He proposes to have exemptions for things like banks and infrastructure funding companies, but we'd be interested to see what those are, because clearly quite a lot of infrastructure funding projects and PFI projects simply will not be viable if they cannot get tax relief for the financing interest costs. The Chancellor has also said that he proposes to review the general regime for company taxation. What he wants to do is to reduce the apparent advantages that an individual gets from supplying his services through a company as opposed to providing them presumably as a sole trader. A lot of revenue is being lost by people trading through companies as opposed to other structures. The intention is to produce a consultation document on that, so we shall have to wait and see what that says. If a person registers for the flat rate scheme, if he sends out a bill for £100, he charges £20 VAT. Clearly, if a person has very few expenses, then he's rather better off under the flat rate scheme because he pays less than £20 to HMRC. In order to make this less attractive to people who have very few expenses, the proposal is that if the costs are less than 2% of the turnover, or £1,000, then that flat rate percentage will be 16.5%. The amount that can be contributed each year to an individual savings account is now £20,000 per year. I wonder if ISAs will in some ways replace pension funds for higher paid employees. In many cases, their contributions may be limited to £10,000, and in a number of countries, pensions are structured on the basis that tax relief is not given on the way in, but equally pensions are not taxed on the way out. Those of you who saw one of my previous budget presentations, I theorised that perhaps the Chancellor would do this with all pension schemes. It was certainly one option that he was looking at, but he didn't actually take it up. EIS VCT schemes, there are some technical changes, but these still seem to be government policy. Government still seems to be very keen on them, so no intention of restricting those significantly. That's all I have to say. My name is Robin John of Wellden Turnbull, and thank you for listening.